31 optional exits. Here we have done given the choice to you, the discretion in the investor's hand, whether you want to double down, whether you want to exit fully, whether you want to exit partially, or you want to exit not at all, given your conviction in the game. But overall, 48 unique startups generating 61 exit events. So even for these 31 optional exits, there have been more than one event as well, where there have been multiple exit opportunities also created, right? And that's not all. These are just the exit. In the next slide, as we see, we are going to talk about the follow-on rounds as well. So exits are usually created along with the follow-on rounds. 82 startups of IPV have gone on to secure next round of funding at a valuation higher than our funding, right? So which is an IRR of 95%. And again, some very well-known names. A lot of these will be in your portfolio as well. This becomes the base for us to now drive exits for these startups, right? So when people say that what's in this year, what's in 2025, how are we going to create exit? This is the homework for us. These are the list of startups that we are focusing a lot on, and will very soon come back to you with more exit opportunities across these as well. Next. Cool. So some hard-hitting numbers, as I always say, in God I believe, but rest all please bring data. So these numbers are a result of some real deep analysis. A lot of people often ask us that, okay, what's the formula for exit? How I should be investing, when I should be looking at good exit opportunity. All in all, after a lot of analysis, what we have come to is the middle chart, as you see. If you are, as an investor, have the patience to stay invested for more than 3 years, and if you have invested in 10 plus deals of IPV, you stand on an IRR of 55%. So the 41% IRR that Vinay spoke about, wherever you have invested in startups with a vintage of at least 2 years, the same number actually moves up to 55% when you talk about this set of investors who have been patient, who have been perseverant, right, and have invested in 10 plus startup over a period of at least 3 years. And you can be one of them. There have been some amazing opportunities. 2024 was full of some great exit opportunities and stories. We gave exit in Samosa Party, where a family office driven exit it was through DS Group. Bloom, one of our very close VC partner, gave us exit in two marquee entities, Stage as well as Fesher. All of these gave not only a great MOIC of anywhere between 3 to 4x, but great IRR as well, between 30 to 50%. And finally, a takeover transaction where Precinto got acquired by none other than IBM, giving us proof of concept of our choice of investing in the startup early, right? Even though there was not much revenue traction. And again, it was a great exit at almost like 4x. So this is what it is in terms of cash return split. On the left-hand side, almost 50% of your exit amounts are coming from exits where the returns are anywhere between 2x to 5x. And this number moves to 20% when you look at 5x exit as well. So 5x exit, 20%, in fact, it's returning your entire capital, right? So we look for more such winners where we are able to drive more and more higher MOIC with great IRR as well. Next slide. Cool. So I think the philosophy remains the same. This is something that we have been educating our investors all around, right from the beginning, across all our master classes, all our rendezvous sessions also, and in our one-on-one also, you'll see us, professing for this. That is always, always, always consider an opportunity for a partial exit whenever there is an opportunity, right? Take three personas, Aditya, Bushra, Rishi, our own colleagues. So Rishi is the guy who is always taking partial exit, right? Now, when he has taken a partial exit, the startup after that can go down to zero, God forbid. There have been cases as well. And yes, this particular example is also a live case of one of our own startup. The startup can go down to zero also. The startup can go to 9x as well. He will be happy, or this person will be happy in all these situations, because not only has got the capital plus some return in the bank, he can still continue with the balance amount for reaping the benefits of the future reward also. The other two, who has either exited fully or not exited at all, will be unhappy in one of these situations. So overall, there is a formula given over here without getting into much detail. But if you invest a certain amount based on this formula, you will make sure that you are getting home your capital as well as some cool IRR to protect your wealth as well. Next. Great. With this, I hand over to my colleague and friend Ankur to take us through what we have been doing on the investor side, which is you. Over to you, Ankur.
Thank you, Mitesh. Some really wonderful numbers there. Learning from Steve Jobs, the only way to do great work is to love what you do. And this is the same philosophy and ethos we bring to work every day. And it's actually not very tough for us, because IPV was never started as a business. We started IPV with the objective to, it was just three friends coming together. And what we wanted to do was that we wanted to pool in not just our capital, but we also wanted to pool in our intelligence, our expertise, our knowledge, our network, our resources so that we can invest in startups, have a very high success rate, and actually able to generate great returns from this asset class. And nothing has changed except in 5 years, that network has now grown uh, to over 46 countries. And this is the year 2024 where we deepened our roots across the world. Starting with MENA, we, for the first time, did investor sessions, were invited by the local government corporate bodies to hold special sessions on topics like Indian startup ecosystem in general and IPV in particular. And we held these sessions in countries like Saudi Arabia, Kuwait, Oman, Qatar, Bahrain for the first time, while further deepening our roots in UAE, which continues to be one of our biggest investor base outside India. We have entered into partnerships that takes us to Africa, starting with Nigeria and Ghana. In Southeast Asia, we did sessions and met investors in Singapore and Hong Kong, and we have our sites on Indonesia, Taiwan, and Australia, and New Zealand. And for the first time in 2025, we will be hosting investor sessions in Canada and US. Now, during these trips, we came across some very interesting observations and realizations. One, we came and we met a lot of very interesting startups, which we would have loved to invest via IPV. But many of you would have realized that we have not brought any non-Indian startup over the last 2 years to IPV, and largely because of the regulatory challenges to fund the startups outside India. The other very interesting realization was that now not just Indians, but foreign nationals are very excited to be part of the startup Indian ecosystem, because what they see is that their governments, large VCs, PEs are already writing big checks, and they typically like to follow where those big checks are following, but in their own manner. But yes, for an individual investor, the compliances that are required to be part of the Indian investment space were cumbersome and therefore a little bit prohibitive. Our search for the solution brought us to our Gift City Fund, IPV International, which we are very happy to announce is now active, up and running over the last 1 month. It provides two key features. One, it allows Indian nationals to invest in startups outside India, for which we have already started the process, evaluated 300 plus deals, and in fact, we have already done 2 founder calls in the last 1 week. Last Wednesday, which was Realcraft, and earlier today, which was Celebrate. And in fact, we have introduced a new slot of 8 p.m. on Saturday, like Vinay mentioned, to accommodate our growing investor base, especially in the Western Hemisphere, who often used to tell us that the Saturday morning time doesn't really work for us. The second problem we are solving is for the foreign nationals or Indians who want to be part of the Indian startup ecosystem, but they want to have a little bit more, relatively more friendly, compliance requirements, and Gift City offers that. We are also simplifying our product portfolio. When we started our journey as angel investors way back in 2013-14, the minimum check at that time used to be 5 to 10 lakh rupees per startup or investor, more 10 lakhs per startup or investor. And for us, that 10 lakh rupees was a little bit of a problem, because we wanted to invest an amount which allows us to invest in 12 to 15 startups at least. But at the same time, it is a large enough amount that when invested and when the exit comes, that amount brings great joy. And after a lot of research and understanding, we came up with that number to be $4,000, which based on 2017-18 exchange rate was translating into about 2.5 lakhs per startup per investor. Over the last 7 years, we maintained the same number, but as the rupee is now inching towards 90, we decided at the time that we increase that amount, minimum amount, to 3.6 lakhs per startup per investor, which will be effective 1st May 2025. We are upgrading our Premier Select program, and we are including the benefits of our AIM Plus program into the Premier Select, where the senior RMs will be working with them more closely, and they will be getting shown the 5-star deals, which we used to previously call A Plus deals, which basically means that out of 3 of us, at least 2 of us are investing in those deals. Now, this is very important because, any deal that comes to IPV, we are probably the only platform in the world where it still happens, where at least one of 3 of us still has to invest in every startup that comes to IPV, true skin in the game. We are also upgrading our MBA program, partly to adjust the requests coming in from the founders, especially those founders who are raising from multiple other platforms and funds. And in the new upgradation, you can continue to invest under MBA, which is the amount of 1 lakh. But under direct investment, the number of investments will be 1, and under AIF, it will be 3. However, we will continue to honor our commitment to those of you who are already part and undergoing through this MBA program, and for those who will start their journey before May 1, 2025, when these new numbers come into effect. Our ambition always, when we started IPV, we were often asked, why are you starting IPV when there are already so many angel networks? And we were very clear that we were not getting what we wanted. We wanted a very good deal, deal flow. We wanted good evaluation, and we wanted to help the founders, work with the founders, oppose the investment, leading us to exits. So we were very clear that our ambitions are far loftier. We want to become one of the leaders, in the early stage investing space. And Steve Jobs' mantra to that is innovation. Innovation distinguishes between a leader and a follower. And that has seen us investing in sectors that have the potential to shape the future. 2024 saw us investing in a space tech startup for the first time, Dream Aerospace, expanding our roots into the robotics through social hardware, Vividobots, whereas we are deepening our base in sports tech, artificial intelligence, deep tech. Even in D2C space, we have invested in innovative products like healthy and guilt-free ice creams like Noto. 2024 also saw us expanding our base across India. We have entered into partnerships with leading portfolio managers and advisors like Novama, whose leadership team is already investing via our platform. And they wanted to take our products to their investor base. In fact, last year, we launched the WealthWise Partner Awards. We started with Bangalore, recognizing the wealth managers from South India, recognizing the great work they are doing in bridging the gap, like Vinay said, between India is getting rich, will Indians get wealthy? So we recognize those in Bangalore, and next week we will have this similar event in Delhi where we'll be recognizing our WealthWise partners from the North India. We also did masterclasses for KPMG, Indian Oil, Capgemini, and many other companies, including many startups who have gone for IPOs or are coming for IPOs, as many of their employees will come across capital which they would want to invest in startups, because IPV is not just about investing in startups, it is also about education. And that is why we also deepened our roots with alumni associations of IIT Madras, IIT Bombay, with a unique perspective of not only bringing in like-minded investors, but also creating a unique deal flow for our investors to evaluate, all with the objective and the determination to become the largest angel AIF in India. And how have we done so far? I would say fairly well. We already have a committed capital of 750 crores plus through 2,100 contributors, which someone was telling me makes us probably one of the largest category 1 angel fund in the country, out of which 384 crores have already been deployed. And Mitesh already told you that, cumulatively we have offered 330 crores exit. Of course, it includes some of our direct investments also, which is probably the same number as YR AIF. But now our AIF only deals have also started, really growing big. In fact, in Noto, we maxed out the maximum number of investors that can allow in any one scheme of the AIF. Vinay talked about DMAT journey. It was cumbersome. It was, it required our teams to work not just with the investors, but also with their banks and with the organizations like NSDL, CDSL. But we took up that challenge because overall, it's a good process. It is overall creates far more transparency and should help in exits. And so no matter what were the challenges, we were able to solve the problems of the founders and the investors in deals like Conscious Chemist, Aksam, Freed, and Sayug. And that's not all. One of the comments and feedback we got, and like Vinay mentioned, we learn from our customers. And we were told that, our social media presence needs to improve. And so we have made some small but strong steps in this space. And we look forward to getting more feedback from you and improving it. We launched our own podcast, Beyond the Pitch, where we speak to IPV portfolio founders. Should be a good learning, a lot of interesting information for both investors and founders alike. We have launched our monthly newsletter, Finflection, and our bi-monthly blog where we try to bring more relevant news for the startup ecosystems, but in our own funny, quirky way. Hope you're enjoying these blogs, these podcasts, these newsletters. And one of the things you would have noticed last year is we adopted a new logo, which is more reflective of who we are. We want to continuously move forward while doing what is right for our investors and for our founders. So with that, I hand over to my friend and partner, Vikram Ramasubramanian.
Thanks, Ankur, and good day, everyone. And as Peter Drucker said, the best way to predict the future is to create it. And that's well built into our mission and vision. We build processes that are built to last. We are a people-first organization that's embedded in our culture. And our initiatives are built on critical thinking oriented towards growth. And our decision makings are always data-driven and unencumbered from biases. We take a measured start, go deep, and then expand exponentially. And this is reflected in everything that we do. We set out for a mission to democratize angel investing and to improve the success rate of startups by at least 10x. All this to lead to great returns for our investors and immense satisfaction for our founders that work with IPV. That said, we also invested time, we not just invested money, but also our network experience to grow the startups. We hosted over 650 SIP calls through the year, review the performance, and guide the startups. 88% of these calls had their decks and information published beforehand for investors to come prepared. We ran over 188 Let's Grow programs where the mentors came on board to help the startups. And we're immensely thankful to the 700 plus mentors who gave us their time to guide the startups. And one thing we learned from all this is from our failures, where we did not run the Let's Grow program, the startups tend to fail more. And for those where we ran the Let's Grow program, where there was limited participation from the mentors, the startups tend to fail. But the interesting story is of resilience, where the mentors invested time and gave their efforts. These startups were almost brought back from death and to thrive and to raise more money from other large VCs. So Let's Grow is all about investing your experience across supporting the startups, guiding the founder, coaching them, and to correct their business plans and to challenge their assumptions oriented towards growth. That said, we also invested a lot of time in investor education and query resolution. We hosted 33 masterclasses and what, why, and how sessions to answer over 400 questions live across 13 sessions. We answered 3,300 plus queries, whilst maintaining an average stat of about 48 hours, answering close to 1,200 AI-related questions, 200 diligence-related questions, 550 tech-related questions, and more. And this helped us refine our investor communications for faster updates to investors, automated the unit statements, and made it real-time and accurate. And we also brought dedicated ISMs or investment success managers for NRIs across time zones. And not only that, we also built frequently asked questions, answering over 250 questions that were commonly asked by investors across 8 categories. Right? And externally, we also forged relationships across the ecosystem. We hosted 59 VCs across Delhi, Mumbai, and Bangalore. We hosted 170 plus VCs across 2 virtual events. We went and made connects with over 750 VCs, made 500 pitches of our startups across the 370 plus in-person meetings with them. And not only that, during the year, we also acted as investment bankers to our startups. We took up 5 mandates and made over 200 connects. On the other side, we also built partnerships across banks, software companies, and other service providers to help our startups grow, not only with the money that we invest, but also the ecosystem connects to help them accelerate. That said, we did all this whilst running a large ship. We did over 118 founder calls, 73 investor calls, and it's no simple task to run over 2,500 WhatsApp groups and keep the communications seamless. We also hosted over 600 plus SME calls, which were very, very insightful for us to do our diligence and to bring the best of startups to you to invest. And all this we did aided by technology. During the year, we revamped our user interface. We brought in seamless in-app renewals. We brought the investment view. And most importantly, we also had the annual investment detail download. And you could also now purchase your membership. And we have a new renewed section for startup deals and the points ledger. And we're not stopping here. We're going to be working on the B2B web portal, B2C web portal launch, the deal ratings, and interest in closed deals as well. And all this whilst remaining focused on our principles. At IPV, we are one entity with a purpose. We're two sides of the same coin. And we believe in our three pillars of investing, which is investing in great businesses, run by great founders, available at a fair valuation. And we use the 4 ACEs framework, which is ask, analyze, anticipate, and act. We summarize our learnings in the Porter's 5 forces, and we encourage our investors to apply the 6 mindsets or the 6 sense in investing. We apply the 7 tests to identify great founders, and we apply the 8 tests to invest in great businesses. And all this for 10x investor returns to our investors. And that said, all this is not possible without our people. Now I hand it back to Vinay to take us through the rest of the slides.
Thanks, Vikram, for the closure. As we hit 6:45 p.m. mark and we're known for closing on time, I must say a big thank you to the teams that work with us. They work together, they work hard, they achieve together, they have fun together, and we stay committed to make a meaningful life and a career that's an inflection point for them as well. These are some of the glimpses of how we have come together as one of the largest VCPE team in the country, with more than 240 professionals work together across 7 locations in the country. And that's not all. We also want to be committed to the society. As Mahatma Gandhi said, the best way to find yourself is to lose yourself in the service of others. This year, we expanded our wings here. We set up a 1,000 square feet computer lab with 16 computers and LCDs, providing access to 500 rural students of a school in Amritsar. For South, we supported 2,500 OPD consultations and 2 critical heart surgeries for those in need in southern part of the country. In the eastern part, we sponsored full education for 100 underprivileged children, which were on the roads and no previous access to schools. Coming back to the pollution of North, we supported 2 lung awareness programs and 1 life-saving lung surgery with support post-surgery as well. And that's not all. Since we are a financial services organization, we delivered financial literacy to over 500 students in personal finance and handling finance. Last, 1 tree planted for every investment and every exit we completed this year. This was supported and worked through with partnerships with the names listed at the bottom of the page, namely Manav Kalyan Trust, Hope Mirror Foundation, Lung Care Foundation, Satya Sai Central Trust, Prime Minister National Relief Fund, and Punar Jagran Samiti. So we can remain committed to growing our country, to the social cause, to our people, to our founders, to our investors as we go along. With that, we are very thankful to the leadership team that I have, very committed, very oriented, goal-oriented, and that has fun together working along. Not just that, as they say, the buck still stops at the leadership level. We stay responsible while the IPV stays investor-focused, founder-friendly, and tech-driven. We will achieve this by staying resilient through the ups and downs of the environment. We'll continue to work towards being the world's most trusted investing network while remaining day one for us every day when we come to work. So with that, let me close with a simple quote of Lao Tzu, who says that the journey of 1,000 miles begins with 1 step. And with that, let me hand it over to the 2 Ankurs, the 2 heroes that we have for today, Ankur Mittal and dearly welcome Ankur Warikoo, who I've known for years as a great mentor and somebody who I have great respect for. Back to you, Ankur, to invite Ankur Warikoo, and then over to the conversation.
Thank you, Vinay. Yeah. If you can please have Ankur's introduction. But Ankur, welcome to Rendezvous. It's something which we started almost 5 years back, and the objective was that through this session, we want to tell our investors, our stakeholders, how we have performed in the last 12 months. But at the same time, we want to bring visionary leaders from whom our investors and our founders can learn a lot. Over the last 4 years, we have been fortunate enough to have leaders like Kunal Shah of Cred, Varun Alag of Mama Earth, Sanjeev Bhikchandani Info Edge, and Amit Jain of Car Dekho. And we are very, very happy to have you in our 5th edition of Rendezvous. So, a quick introduction about the person who probably doesn't need a lot of introduction. But Ankur Warikoo, after completing his schooling and college in Delhi, went to US to do his master's in the Michigan State University. He's an MBA from ISB. Started his career as a consultant at A.D. Kearney. Was a venture partner at Rocket Internet, and therefore, as a part of that, became part of the founding team or the initial team at Jabong.com. He had some very large stints with Groupon, and in a management buyout, he created Nearby, which got invested by Paytm, and there was a merger with Little. But what we know Ankur Warikoo is today as a somebody who we love forward to listening to. He is a content creator. He's an author of 4 epic books, and somebody who has imparted education to 440,000 plus students and has a social media following presence of over 13.5 million. Ankur, pleasure to have you with us.
Thank you so much. Thank you for the very, very warm introduction. I have to start with congratulating the entire team. I was a mute spectator to the presentation. Commendable job. So inspiring. And I love the fact that you covered all possible grounds. It wasn't just finance and one side of the equation, but you understand how the ecosystem builds itself and builds itself so meaningfully. So my deepest respect and appreciation for the hard work that all of you have done, and such a wonderful initiative to have Rendezvous and make it so transparent. I wish everyone did that, because private investing is, as the word suggests, so private that a lot of people never get access to all of this information in the way that you have been so transparent. And I am such a huge proponent of transparency that it was immensely gratifying to be part of this conversation for the last half an hour. Thank you for having me. It's a pleasure.
No, pleasure is all ours, Ankur. So diving right in, you have been technically part of the startup ecosystem from when it just became popular, like 2008-9 onwards, by being part of Rocket Internet. You yourself started your journey as an angel investor circa around 2014. So why did you want to get into startup investing, and what were the challenges you were facing then as an angel investor?
Why I wanted to get into startup investing was the classic frog in a well syndrome, because you are a startup founder yourself, you're surrounded by startup founders, all the conversations are almost always about investing and funding and exits and unicorn status and so on. So and I'm not proud of who I was at that point of time, and I'm sure that the investors as part of IPV are much wiser. I used to believe that people who invest in the stock market, invest in real estate, invest in gold, were the duffers of the first order, because the only money that one makes is in startups, and that's where everyone should invest. So much like the stupid person I was a decade back, I started investing because I believed that was the absolute gold mine that gives you massive alpha without recognizing the beta that comes along with it. And because you're a startup founder, of course, there was some bit of deal flow. But what I truly discovered is, one, angel investing is not easy by any measure. I, in fact, think I make one of the worst angel investors, because I tend to fall in love with the founder a lot more than I should. And I don't evaluate the business on its merit and on the strong grounding that it should have. And I'm like, nahi, mehnati ladkiyan kar lenge, and let's just go with it. And that never really works. So I was driven a lot by emotion, and I was driven a lot by FOMO and what the trend was at that point of time. So the deal flow was always there, but there was absolutely no criteria to judge. And because you're an operator yourself, and don't have the eye and the lens of an investor, you're almost always making calls which are one-sided from the operator side, and you just fall in love with the grind and the hustle, not so much the outcome of it. And I should say, as something which everyone should be cognizant of, that in the first 4 years, I believe, when I started 2013, 2014 till about 2016, 17, I made about 18 investments, and 16 of them shut down. And one of them gave me 1x the money. And I just completely lucked out that one of them gave me a 22x. And I do not take credit of that at all. But I can very clearly say, oh, I had an XIRR of 75%, but deep down I know it was just bullshit. Like it was just absolutely the worst way to do any sort of investing. And when I was going through your numbers, it's like, aisa hona chahiye. I wish this was there at that point. And the angel investing was just such a club membership kind of a thing, where getting on the table and having a seat was just, no, nahi, aap to itni dur hain startup ki duniya se that no, you're not even allowed. That it was not easy being an angel investor, and certainly wasn't easy building it as an asset class if anybody wanted to.
And you know, the bigger part of that problem is that those 16 failures would have come far earlier in the evolution of those startups, and that 22x would have taken its own time. So you are
exactly. You're so right. 2019 is when that 22x came in after 6 years, and the 16 just fell like a pack of cards in the first 2 years itself.
Exactly. That is something which we also recognize. And now that you have, you know, learned so much and experienced few things, something I want to touch upon is your journey at Nearby. You know, management buyout is probably not a term that a lot of people in India know, of course, you know, but you did that, and you saw that business through investments, through mergers. And looking at the journey that you spent with Groupon and Nearby, what would you like to tell the investors, like, you know, who are investing behind these startups because of the journey ups and downs, and also the founders? Because, you know, rarely would you come across a startup which will have a complete, you know, just a straight up growth path, and the growth path will be, you know, up and down.
Yeah, exactly. Let me start with the founders. So to give you context of the question that Ankur was asking, I started Groupon India in 2011, ran that till 2015. And then in 2015, we did what's called a management buyout, which is a term I had learned in MBA, but never experienced it myself. But we were able to pull it off. So we partnered with Sequoia Capital, which is now Peak 15, and we wrote a fairly big check, the largest that Sequoia had ever written as their first check, $17 million. And we bought out the majority shareholding of Groupon in Groupon's India business and made that into an independent entity that became Nearby. And as part of that deal, the founders got a healthy share of the business. Groupon still continued to be but a minority shareholder, and then Sequoia was as the primary investor. And then we ran that. So Nearby started in 2015, and it was a completely new brand, new platform, new business model, everything from scratch. And the only thing we had resident was the team that came along, and of course the operating merchants and consumers that we still had. And I tell you that this was the first time that I'd raised institutional funding, because my first startup when I started in 2008, 2009 was friends and family. Groupon was, of course, an entrepreneurial experience, but I was still funded by a corporate. And it was like drip irrigation, where whenever we needed money, we got it. But this was the first formal time when I'd had a bulk of money hit our bank account. And for the first time, I saw 100 crores as our bank balance. And I did what I'd argue would be the most rookie mistake that a funded founder would make. And that was to believe that money is the problem to all your solutions. It isn't. Money is actually, I remember speaking to the Kunal Behel, Snapdeal and Titan, and he was like, never congratulate a founder on raising funding, because that's like congratulating a chef on buying vegetables. It's just the ingredient. It is going to make things happen, but the dish has to be served. It has to be priced right. People have to love it, and they have to love it enough to come back to it. So ye to abhi shuruaat hai, bro. And there's a lot that's going to happen. But in my heediness, I was like, no, this is the end, and we've done it. And I spent money on building a fancy office. I spent money on really cool perks, on giving out crazy salaries to people that I thought were amazing because their pedigree said so. Spending a lot of marketing without realizing whether the product was ready for that or not. So classic mistakes that I take full ownership of. And within a year, we were burning through money while we were growing like crazy, but the loss, frankly, didn't look any appealing. And it just so happened that it coincided with a winter funding that happened around 2017, 2018. Not as severe as what we've seen recently, but still enough to have investors rightfully question the fundamentals of the business. And that then shook us, and we had to then go through a really difficult time, lay off people for no fault of theirs. And my only advice to founders will be, please listen to the market, because the market is constantly telling you what you should do. The best thing about consumers is that either through their silence or through feedback, they'll always tell you what you ought to work on. And if you're willing to hear and if you drop your ego, you will learn a lot about how to run the right business. And also recognize that any money that you raise always has a color. All money is not the same. The kind of money that you raise from someone like me is going to be vastly different from the kind of money that you would perhaps raise it from any other angel investor, or if you will raise it from IPV, because they come with the strength and the ability to nurture and fill in all of your blind spots. They come in with the sense that we want you to win, because it's skin in the game. It's absolutely the right incentive. And that means that if you don't raise money from the right kind of people, then that money could be far worse than not raising at all. And I've seen so many founders just destroy the way that their startup could have operated because they raised it from the wrong kind of people and they raised the wrong amount. And of course, then the second thing, which is they spent it on things that didn't make any difference in the consumer's mind, which ought to be the primary purpose for any funding. For investors, just to complete the question, I'd say that question very incessantly what the use of those funds will be, and be a sound bouncing board. Because the truth is, when you get a lot of money, either in personal life or as a founder, not a lot of people are taught what to do with it. And we then gravitate towards the lowest common denominator, which is no, badi gaadi kharid lo, bada ghar kharid lo, mehanga phone kharid lo, achhe kapri kharid lo. And in founders' life, it is like, oh, let's invest in a cool office and rebranding us and merchandise and swag, and let's get a celebrity endorsement done and blah, blah, blah. None of that, frankly, makes any difference in the life of the consumer, because the consumer's like, make me a product or a service that I truly want to buy and buy and buy and buy again. So if you are surrounded by people who keep calling out your bullshit and genuinely mean it well when they do so, you will always be thankful. And I believe that you as an investor ought to play that role, because if you can't, then you're failing in your fiduciary responsibility towards your LPs and also towards your founders.
No, absolutely. But just continuing with that, you've been a founder yourself, even though you may not have raised money from angel investors. Anything that you would say, from your experience, that the investors shouldn't be doing when investing in startups? Is there some, some of your experience there with the startups you may have invested or not invested?
It's a really fascinating question, because particularly when you're very early, as IPV is, as much as you would sit on numbers and as much as you would be objective and as much as you would be anal about whether the business is run in the right way, the founder is, so on and so forth, there is just so much of quote unquote randomness and uncertainty that one can't predict, one can't price in, one can't plot. So I believe that as an angel investor, at some point of time, you will have to rely on gut, which numbers cannot perhaps validate. And I'm sure in the IC meetings of IPV, there are a lot of these tussles, right? Where the Excel is giving a number, but someone in the team is like, nahin, there is something that tells me we should still do it. And it's quite possible that those are the ones that have gone on to make remarkable exits for you. And there's nothing that explains that. But the more later stage you get, the more robotic you ought to be. Like, imagine the highest order, which is PE. There is almost zero emotion attached in PE, because PE is like just an Excel sheet, and whatever number is throwing, that is the holy truth. And that's what they will go by. And they will, once they make that investment, even get to that point to the highest level possible. But I do believe as an early investor, either work with a team that has built its intuition over several years, or build that yourself, which is, of course, hard. And I would say don't always just rely on those numbers, because it's so early and it's so random and so many things can happen that you never know what the outcome Could be. Like, and I'll always quote this example, and this is not an endorsement by any way, but because I've seen Vijay Shekhar Sharma of Paytm very closely, worked with him after they made an investment. What happened after demonetization in 2017 is not that nobody else could have done what Paytm did, but somehow there is something about that personality, about that fitrat, which says, once the moment or the opportunity comes, if I were to make a line of everybody who can seize that opportunity, I know that one person somehow will emerge victorious. I can't explain why, I can't explain how, but when I meet that person, I just get that sense. And I would perhaps take a bet on that, as much as the numbers are almost equal for everyone else. But if I have to take a call, I will. And those are the kind of smell tests that you would want to also rely on as much as you rely on your data.
Awesome. No, this is very, very helpful. Okay, so, I've seen some of your podcasts, you talking about, financial products, markets. And, Vinay, in one of the slides earlier, mentioned something very interesting, that how Indians invest. Indians have 51% still in real estate and a large percentage in debt, while HNI in US has about 8% allocated to PVC, and even a non-HNI American has a 45% equity. So my question is, how do you see angel investing as an asset class evolving in India over the next few years?
I genuinely believe that the next 2 to 3 decades will make this into a mainstream asset class. And the reason I say that is because there is a much higher success rate of startups than used to be, because so many things have just worked. There is capital, there's infrastructure, there's a market. The market is not just India, but now suddenly global after COVID. And it's not just for software, but even for other products. The audacity of founders is much, much higher. There have been successful exits. There are founders of the first gen, the OGs, the Sanjeev Bikhchandanis and Deep Kalras of the world, who are now giving back in a way that was never possible, and the Sachin Bansals and the Binny Bansals of the world who are coming back. So there is the wave of founder money coming back into the ecosystem, and a lot of mentorship and so on happening. So that's number one. Number two, I do believe that as the country progresses in its wealth, there will be disposable income that will come through, and people, as always, will want to diversify, and they will diversify either to manage risk or to manage growth. So either alpha management or beta management. And what angel investing does, especially if it's done through a very curated fashion such as IPV, it brings the best of alpha and beta. Because as I said, if I were to go and do angel investing myself, I'll be looking at the alpha, I'll be like, oh my God, look at XYZ, and they've made so much of money, and 100% IRR or whatever. But I have no way of assessing the risk attached to it. But if it comes through an expert and an organization and a setup that manages that risk really well, no one can really eliminate it, then that's a great way for doing that. And think of it like any other mutual fund or a PMS, where the expert is doing precisely that. They're like, okay, tell me what your IRR expectations are, tell me what your reasonable hurdle rate is and whatnot. And if you want to get, okay, a 20-25% in the stock market over a long period of time, 10, 20 years, this is the kind of volatility you will have to be comfortable with. And if you are, I can give you those recommendations and make that happen, or to a reasonable extent. And I think that that's going to be the same case as people have more and more income come through. The biggest thing that has happened, as I said early on as well, that angel investing deal flow was always a problem, because retail investors don't even know that. It's funny, I was having a conversation with 2 founders yesterday who are building a product for SMEs. And I was telling them the second gen SMEs hate the startup world, because they're like, bhai, PAT hum bana rahe hain, GST hum de rahe hain, income tax hum de rahe hain, aur wahwaiyan tumhari ho rahi hain. Like, you're getting the founder 40 under 40, you're being celebrated on Shark Tank, you have never seen profit one day of your life. We are the ones who have actually built an asset class and a company that's cash flow and has net worth. So there's almost this angst. And I don't know if it's true for IPV in terms of your investor base, but I'm yet to come across any first or second generation business owner like the Dhanda Walas who don't ask me, भाई ये angel investing कैसे होती है? क्योंकि हमें ये करनी है. हमने real estate खरीद लिया, हमने गाड़ियां खरीद ली हैं, हमने stock market में डाल दिया, सब कुछ हो गया. But this is an asset class that we have no way of touching. Like, you are the startup guy and you get all of this, but we don't know how to. And that's why they will go all to these angel networks and so. So as more and more democratization happens through platforms such as yours, it's going to get more and more retail. It's an eventuality. And I think the next 2 to 3 decades, absolutely golden period for this.
Awesome. No, thank you. What we'll also do is we'll have Mitesh when they pick up some questions from the audience so that, we address those also.
Sure.
Sure. So,
Go ahead, Mitesh.
Hi, Mitesh. How are you?
great, Ankur. Yeah, thanks for gracing the occasion. Candidly enjoying it, and so is the audience. So we'll take a couple of questions here. Question by Prasad Pujari. Should a startup consider its competitive moat from the very beginning, or is it something that can be identified and developed over a period of time as the product and market evolve?
Is this specific to the moat? Did I hear that right? The
Yep.
product moat?
Correct, the competitive moat.
Yeah, okay. I will have to say, Prasad, think about it from day one, because please recognize that India is a very different market from the developed markets, where we're still a poor emerging country. The depth in the market is not too deep. And that means that if in the early bit itself, you are fighting a competitive or a commoditized war with either existing players or somebody who can come in and do the same thing that you do, it's quite possibly that there aren't enough people to have space for everybody. And suddenly you may just get priced out or qualityed out or capital out. And you wouldn't want that. So if there is any distinction that you can think of from day one itself, however small, however trivial you may think, and make that the cornerstone of your product, of your communication, of the way that you approach, then that will always help the consumer retain some bit of edge in you as against something else. While that continues to be the forever moat, not necessary. But please have one right in the beginning. That would be my suggestion, because then consumers find it far easier to rely on you and to argue irrationally, if I may use the word, that here is a reason I want to choose this company, this service over the others.
No, makes sense. Thank you.
I think I'll pick up the two comments for you, Ankur, here. One is from Pankaj Sharma, who is saying that you're making an immense sense for him. So thanks, Ankur, for making it clear. Thanks, Pankaj, for that comment. And then another one from Vipin Menon. He's saying that Ankur Warikoo has been very candid and frank. Liked it. So thanks, Ankur, once again. And thanks, Vipin, for that comment. And Ankur, one question that's coming is, you said don't rely too much on numbers, which also means that the numbers is the more mathematical and the scientific part of the story. But there's also an art and a kind of experience part of the story, which I think is the founders. Businesses you can evaluate on numbers, founders not so. And as you said, you earlier invested behind founder. Acha lag raha hai, chalo kar dete hain. Help us understand, how do you really look at founders? You having been one and having looked at many, what are some of the traits you look at in founders?
No, I don't think I'll give a very popular answer, or a popular version of this, but I will say this. I have found in the last 16 years of being in the startup community that the ones who have had it relatively easy in life and yet being very successful. So mind you, I don't think anybody who has not been successful will even come to that table, but they've had it easy, they're very successful. Those are the ones that, in my experience, will fumble the most when shit hits the ceiling. Let me give you an example. I do say this, that entrepreneurship is the most brutal form of self-discovery. What I mean by that is, none of us will ever buy a product from a company because the founder went to IIT or IIM. We don't care. None of us will ever buy a product from a company because the founder has not taken a salary in the last 6 months. None of us will ever buy a company because the founder just raised an obnoxious amount of money from really cool venture capital. No, we don't care. What we care about is this one thing. Are you making something that I enjoy, that I love, that I'm willing to pay for? And that means that where you studied, how much you scored, where do you come from, how cool do you look, how well do you speak, how well do you dress, none of that matters. It's just, absolute bullshit. But a lot of people are not used to that. They're actually used to life working out for them because of where they came from, because of what they've done in the past. And that to me has now, after years of doing this and fumbling, is the common thread. That the ones who came from difficult circumstances, the one who had no choice but to win, the ones who wanted to change their orbit the day they were born, the ones who failed so much that they are badly bruised and yet they have the audacity to stand up, somehow they are the ones who survive and survive like anything else. Because one thing that is so visible, and I was speaking to Deep Kalra last week, congratulating him on 25 years of Make My Trip. I was like, no, it is not a joke that a company in India completes 25 years. And how many companies do we have to name to get there? Like there's IndiaMart, there's Naukri.com, there's Make My Trip, and then you almost run out of names who've been in that 20 plus era. And that means last man standing is actually a strategy. It's not a choice, or it's not just, oh, let's just see what happens. You can choose to be the absolute last person still standing while everyone else has just dropped dead. And the only person who remains standing right till the end is the one who just doesn't know how to give up. And mostly those individuals are not the ones who had it easy in life. So my smell test, if you will be like, भाई तुमने IIT भी पहले अटेम्प्ट में क्लियर कर लिया, फिर तुमने IIM भी पहले अटेम्प्ट में क्लियर कर लिया, फिर तुमने Sequoia से फंडिंग भी उठा ली, फिर तुमने ये सब भी कर लिया. Like where have you failed in life? मम्मा पापा भी IAS ऑफिसर थे. Like what is it that has not happened for you? And then if the answer is no, then like, you know what? Credit to you for having done that. I'm not belittling your intelligence and your raw horsepower. But if I were to pick you, and if I had the choice of picking somebody who came from Jabalpur or some small town, worked their way through, got through IIT, maybe second attempt, never made it to the IIMs, raised it from some friends and family, then hustled their way through, got this large check from an institutional investor one day, I would bank on that person.
Now, phenomenal said, Ankur. I think you summarized it all up. We've codified this, by the way. We call it the Ariel versus the PhD founder. The PhD is a poor, hungry, and driven. And Ariel is, rich, entitled, and lazy. The second category, knows how to communicate, well-fed, well-educated, etc., but not that hardworking. But PhD bucket is what succeeds for us. In fact, 20% of our founders come from tier 2, tier 3 towns today. And more than 50% of our founders don't have an IIT or an IIM degree. And phenomenal successes. In fact, last year, we gave a 40 times return in one of the startups. The guy is not an IIT, not an IIM, comes from Indore, built a great SaaS platform, went global, a great story. And I think what you nailed it, actually, Ankur, for us. Thanks a ton. I'll pass it back to Ankur for more questions, Ankur.
Awesome, thanks. So, Ankur, you wear many hats today: entrepreneur, author, content creator, mentor, investor. What's keeping you, what do you find most excited these days? What's keeping you busy? And what are you looking forward to?
So my heart breaks into a million pieces when people call me a YouTuber or an Instagrammer.
I wanted those words.
Like at 44, that was not the title I was going for. I'm an entrepreneur at heart. I love solving problems. I don't care what way I'm solving them. There was a decade where I was doing venture funded solving. Today I'm doing bootstrap funded solving. And I'm thoroughly enjoying that as well, in such a different way of doing it. My core time goes in building WebVeda, which is my startup that I'm running right now. It occupies a lot of my time because I'm trying to change. The big question that I'm trying to answer is, what will the university of tomorrow look like? And I'm very sure that it will not look like the university of today. I do not yet have a complete picture of what it will look like. But with AI coming in and with an entire generation being raised on that, and also realizing during COVID that online just works, but of course it needs to work elegantly, and offline maybe just for a very different purpose than just getting a degree. I do feel that education is ripe for disruption, and I've always loved teaching, and I've always loved the space of education. I just didn't know that I would find myself here in this shape and form, but now that I do, that's where almost all of my energy goes in. And the content side is just top of the funnel. As a second or a third time founder, I've lost count of how many times I should call myself a founder. You just recognize that distribution is far more important and trust is far more important, particularly in our culture, than perhaps even the product at times. So I'm trying to create the trust funnel through content. I have the sales funnel through my startup, and the two just come together and make it happen. And I'm doing it so distinctly different from how I've done it in the past, that it's fascinating to experience this world, and immensely gratifying.
Okay, Ankur, there is also a appreciation post from Saurabh Namdeo. He's saying, you have changed the way young non-investors think. Do Epic Shit was a life-changing book or an event. So he's thanking you for that.
Thank you so much. Thank you. Appreciate that.
So, Ankur, you have lived a journey as a founder, and a great one at that and all. And at IPV, we believe that founder is at the epicenter of the entire ecosystem. Unless you treat the founder well, unless you understand them well across all circumstances, right? I think you're not doing justice to the ecosystem overall. But yet, I think investors sometimes get impatient, and you have been part of that. So, as a founder, what are the top do's and don'ts for us as investors that you'd recommend?
No, I do say this, that being a founder is a very lonely journey, even if you have co-founders, because no one truly understands what it is to be a founder. So the one thing that I would highly encourage all founders to do is to build a community, build a network. And that's easier said than done, because our culture is a very zero-sum game. It's a very competitive game. It's almost like if I'm exchanging notes and being vulnerable, then one gets an edge over the other and so on. But I would like to believe in the larger good of what founders mean. And there are a lot of good quality founders in this country. You just have to find one and then make this a place which becomes almost like this community or this commune where you exchange ideas, you also challenge each other, and meaningfully so. And with investors, I think the biggest thing that truly helped, because it's not that Nearby had a very easy journey, and to the credit of Sequoia, to the credit of even Paytm and even Groupon for that matter, the one thing that always worked despite all the financial challenges that we went through was just open and honest communication. I don't think anybody in this world likes a surprise at the last minute. And you as a founder owe yourself a moral and a fiduciary responsibility to bring your investors as partners and not as people that you've raised money from that you need to only deliver good news to. Because if you're only thinking, I have to deliver good news, and if I've not grown this quarter, this month, and this week, I shouldn't be even talking to them, then you are, one, completely destroying the relationship that you have with them, and two, not recognizing where they can actually help after they've paid you the money or given you that check. Because the best investors are not the ones who stop at cutting a check. They're the ones who start with cutting a check. And I just encourage all founders to have a relationship where, even if, God forbid, things do not work out, you can still look them in the eye and they can look at yours. And if you were to tomorrow ever start up again, most likely they'll be the ones who will fund you yet again. That's the kind of relationship you want. And that would mean complete honesty, complete transparency. And I'd love for every founder to think of their investor as somebody that they should rely on, and also build a community of founders that they should. And one thing that I wish I had done differently, and now I recognize I should have, is, even though you may and you will have some of your investors on the board, either as an observer or as a primary board member, do meet the broader set of investors that the firm represents unofficially, and do that as a regular cadence. Don't just think of the board member as the only one that you should be talking to, because they will also have their own limitations, because not everyone can do everything. But if you have all of you come together, then there's a lot more power in what is brought in. And I learned that in my consulting days, where it's not the partner who has the answers. In fact, more often than not, they don't have the answers. It's the entire team that has the answers. So while the partner is the front face to the client, but the client will always benefit, and they do benefit the most when they're exchanging ideas with the entire team.
Wonderful.
In fact, this is something which we truly believe in, Ankur, that we are not just contributing capital. And like you said, capital is not the only problem of the founders. Many times the problems will actually start once they raise capital, because then their challenge is what to do with that capital. And for that matter, then we invite our founders to then every quarter come and speak to the people who have invested in them. And some of these investors will be finance experts, some of them will be marketing experts, some of them may have dreamt of building this business, but they couldn't build and, have expertise, have networking. So we encourage that. Yeah, I mean, sometimes, there are all kind of founders. Sometimes they're receptive, sometimes they're not receptive. And, those are all the different battles that we have to, fight in this investment journey. Vinay, I think you have marked some questions from investors to ask.
Yes, I have. I think that was a follow-up to what you said on the EdTech system, Ankur. The question is from Abhishek Pandey. Can we not create a mix of modern education system driven by need and passion and let government also participate in the same?
It can happen if you're thinking about primary education. I do believe that primary is something where the government can do a lot, and to a great extent is already doing a lot, and it remains the foundation of it. I am focused more on what I would call off-curriculum education. If you think about it, once we start our career, we realize that what we learned in school and college wasn't as important as the day-to-day things of how do you communicate, how do you handle negotiation, how do you handle conflict, how do you manage your time, how do you manage your career planning, how do you manage the money that first comes in, how do you build a personal brand inside your company, how do you take initiative. All of those things make you succeed. It's not the accounting and the marketing and the sales and the engineering that's going to drive that as much as all of these other things. So we want to focus on those other things. And that's where I feel that the university role is a lot, because frankly, today, outside of the super specialized things like a doctor or a lawyer or an accountant, if you just want to learn skills, you can go on YouTube and learn them for free. There's absolutely nothing that's stopping you. You can go to Harvard online and learn it from the best university and the best professor. What is lacking is the social fabric of what a university and the college offers. So imagine now if those two come together, then you have a very interesting possibility that's emerging. But the government, I feel, should largely be responsible for primary and to some extent secondary. But beyond secondary, I think it's the onus of the individual and the private setup to take on.
So I know we have 3 minutes left, so I'll try to optimize on the questions we have for you here. I think the other question is, if you were 18 again and you have to build everything again, what would you build and how will you do it differently from Jash Shah?
It's not a fair question to ask, because today at 44, I know so much that I know what I will do. But if I were to do it all over again, then I'm sure I'll be like, nahi yaar, zindagi mein ek baar fundraise bhi karna hai and dekhna hai what it is to raise money from cool people and investors and call yourself a venture funded business and so on. I do exactly the same thing that I've done in life, because I am here because of the mistakes that I made, the experiences I've had, the lessons that I've learned. So I wouldn't change anything. And I would urge everyone to also not be incessantly obsessed with choosing the right path, because there is no right path. You only realize that it is the right or the wrong path after you've taken that path. So go on as many journeys as you can and figure out what works for you and what doesn't work for you. Everyone's answer will be different. And don't think that there is only one way to live life. There isn't. And I would highly encourage, particularly those who are young in their 20s, that please don't try and be in a hurry to settle, to find this one path where you think you'll lead and live life for the next 30, 40, 50 years. It's never going to happen. And the most successful people don't live that way. You would want to rediscover yourself every decade or so. And the only way to do that is if you are formless, if you will. You retain what is the core you, but you can take any shape and form like water can, and become like water, because then water can take the shape of the vessel that it's in.
I think that's the core message from Build to Last as well. Retain the core and, and kind of innovate around. Absolutely. So I'll take the last question here. I think that's from Pratham Jain. He says, for Ankur Warikoo and also IPV, what's the go-to strategy, mindset, and expectations for the first-time startup investing and for people under 25 years of age who are looking to invest?
I would say, Pratham, that's a terrific question, by the way. I would say that please recognize angel investing by definition is risky, but a very attractive asset class. So just as you would treat any other risky but attractive asset class, allocate a certain percentage and don't be greedy about it, but be very judicious about it. So it's almost like if you know that this is the kind of outlay that you have for the year, give or take, then allocate some to safe assets, which keep your money secure. Allocate some to the stock market, allocate some to whatever, maybe say gold or something, and then allocate something to startup, because that could give you a massive alpha over a period of time. But recognize it's a long-term game. It's not going to give you overnight returns. It is illiquid, so you have to ensure that you stay patient. But it's a great way to learn the power of compounding. I do, and this is one remark that I do want to make. I've often asked myself, why do people in India celebrate real estate so much? And here's the reason. The reason is because real estate is an asset that people rarely sell. So that's an asset where you truly experience compounding. The average age of an SIP in the country is about 2 years. The average investor in the stock market is invested for about 4 to 5 years. 4-5 साल में कुछ नहीं होता है. So you don't even know what the IRR could have been if you stayed invested in 15-20. But your dad or your mom who bought that plot of land or that apartment in GK2 in 1970 when it was a jungle, and now you're like, well played parents, like such a absolute rock star of a decision. It's only because they stayed invested in 50 years. Absolutely. And if you stayed invested in any asset class, and take it from me, if IPV stays for 50 years, and let's all pray that it does, if you were to stick, just do the rough back of the envelope calculation. Right now they're saying 77. I'm saying, you know what, even if you get 35 and you get it for 50 years, just do that math. You will be blown out or whatever. But the truth is nobody will stay invested for 50 years. So what I love about any illiquid asset class, if you do it with limitation, is that it teaches you patience. You have no choice but to stay invested. So you can't be like, "Arey dag ho raha hai, tariff aa gaye, arey dag ho raha hai, COVID aa gaya." We don't care. You have to stay invested. So please go with it, and go with it with a certain allocation. And it will teach you at the age of 25 the power of patience and compounding. And then you'll only have to thank yourself for the rest of your life.
Awesome. And since this question was also for IPV, I'll add, if you're looking at startups, look at Ikigai, which is look at 3 sectors. One, where you're professionally trained in, you will understand it better. One, which you are interested to learn about, you will learn it the best, like Ankur said. And third, what you're passionate about. For example, for me, I'm an accountant, so financial services. I play sports, so I have invested a lot in sports. And I grew up buying vegetables and fruits and negotiating, so a lot in grocery and e-commerce, right? So that Ikigai helps you very good in your, whatever little you have allocated towards startups as well. So with that, Ankur, let me take a few moments, and we'll have you a simple memento for being here, and also stay back for 5 more minutes as we give out a few awards as well in your presence. So Ankur, back to you for the recommendation. Yeah.
Ankur, thank you. Great session. There are a lot of appreciation posts there, a lot of hearts and claps and whistles that were given out. As a thank you to you, as a token of our appreciation, we have planted 1 fruit tree in your name around the Chakri Dadri in Haryana. This QR code, we'll send you a certificate as well via email. This QR code will exactly tell you where in that forest that tree has been planted for you. So that is our way of thanking you for coming and taking your valuable time.
That's very thoughtful. Thank you so much.
Appreciate that. Vinay, over to you. So, Ankur, what we started last year was we started recognizing some of our investors who have truly used the IPV platform, both as a way of inspiring and also as a way of telling investors of what is possible and potential. So with that, Vinay, I hand it over to you to recognize some of the investors who were able to use IPV platform to not just gain knowledge, but also to create some good wealth for themselves.
Oh, thank you, Ankur. I'll do that with Rishi, moving to the next page. So the first up, I think we want to recognize people who have truly made great returns. These are the guys who have picked very sharp investments. They have not done 50, 60, 70. There's some questions saying, how do we pick those investments? And these are the guys who made anywhere between 10 to 20, but their IRRs are mind-boggling. So first up is Girish Agarwal. He's been investing since 2018. Probably he picks 1 or 2 investments every year, but he has made a mind-boggling IRR of 101%, which means he doubles his money every year. I mean, this is, he's an IIM Bangalore graduate in finance, so I know how he thinks. He's a CEO today. I know how he builds his businesses as well. So congratulations, Girish. Next up is Chetan Shetty. Again, he's been investing with us for 4 years. Only 11 investments with 91% IRR. So congratulations, Chetan. Amazing way to build wealth. Next is Sanjeev Ray. Again, 5 years with us. 18 investments only, 3 a year, but 79% IRR. Next, Meet Patel. Again, somebody who we came to know during COVID. He was going for his studies into the US. Stayed back because of COVID. Started investing with us. He's now in US. Made 22 investments with us in the last 5 years. Made a phenomenal 76% IRR. A very young guy who really made this happen. And Mehul Shah, member since 21. 10 investments made at 76% IRR. I just wonder how so many people from Gujarat can be on this page. So wonderful congratulations to 5 of you being in the top 5 over the years. And as Ankur said, compounding, patience, and sharp selection. Next up, the next category of awards is IPV Persona Awards. These are the guys who kind of make larger number of investments. They may not choose some of the sharpest, but still end up being great IRRs over their entire portfolio, including losses. So first up is Sachin Gupta, who's been with us for 5 years, 59 investments and 47% IRR across 59. He's also a wealth advisor and a manager, guides investments for many others, and phenomenally has led it by example. Next up, Vinod Agarwal, another CFO who now lives in Dubai, has made 68 investments since 2020. 44% IRR. Congratulations, Vinod. Next up is Rakesh Mistry, who we talk to a lot, I guess, has made 61 investments since 2020 and 41% IRR. And many of these guys you will see are here with us for 4 or 5 years, and those are the guys who are making phenomenal IRRs. And with passing time and higher IRRs, the multipliers are great. And Subramanian, Times Group CFO, been with us 2020, 64 investments and 40% IRR. Uday Shankar Singh, a very different investor from Dubai who was in Merchant Navy and said, I don't know how to invest. I will do all investments you do IPV. And he made 118 investments. Every month he does 2.5 lakh rupees and has phenomenal 31% IRR in across 118 investments, including losses. And last, Joy Kumar Jain, who joined us in 2019, 53 investments and 30% IRR. So I think these are not the best IRRs, but these are the persona awards who look at diversifying their portfolio, yet end up with great IRRs because of that diversification, not just sharp selection. Yeah. So with that, I would like to make a couple more announcements while thanking Ankur. We'll welcome Aman Gupta to our next Saturday in Delhi, live in person. And Ankur, you are invited to, happy to have you in person there as well if you would like. We'll have the registration in the afternoon, a fireside chat with Aman Gupta on Boat Ki Raftar, and many other things lined up for that day on a full day event starting at 9 a.m., finishing around 9 p.m., and a wonderful day lined up for next Saturday with IPV. So back to you, Ankur, for any closing remarks, and for both Ankur Mittal and Ankur Wariko to take this session to closure, after which we'll get down to Q&A for IPV from IPV investors.
Vinay, before we do that, can we take a picture?
Awesome. Sure. Happy to. So we can take off the screen so that our faces are, I guess, a bit bigger.
Who's clicking? Who's taking the picture?
I can click as well if you would like. I can find a print screen button. That's all I have to do, I guess. All right. Smile. Yeah. Picture is taken. Thank you.
Thank you.
Thank you.
Congratulations to all the winners. And Ankur, thank you again for your valuable time. Really thoroughly enjoyed. And, I will make sure that you get the invite for the next Saturday as well. So if your schedule allows, would love to see you there as well. But look forward to staying in touch, learning more, interacting more, and collaborating more.
Thank you so much, everyone. Great work. Thank you for making this so retail friendly and for allowing a completely new asset class thrive in the country. So congratulations. And to all the founders, stay invested for long. 30% IRR, Vinay just called it not the greatest, it is ridiculous. So even if you get that, you're in the top percentile of all global investors with barely any risk attached to you because you have experts who are managing that for you. So love this. Thank you so much. All the best. Have a great evening, everyone.
Thank you. Appreciate your time. For all others, I'll make that number easy for you. If you're compounding at 30%, 1 crore invested for 20 years is 190 crores, just to put numbers in perspective. All right. So let's get to Q&A. Ruchi, if you could help us moderate the questions, and we'll be happy to answer between the 4 sets of us.
I think Vikram is.
Yeah.
Okay, Vikram, sorry.
I'll just moderate the questions. I'll start off with a statement from Mr. Subramanian Raman, very heartening to see this. He says, finally at 68, I have met with what I have been seeking in retirement. Hope to contribute to IPV from day one, feel younger, and the juices are flowing again.
Thank you.
Thank you so much.
Question from Sujit Shah. Most of us do not have the money to invest in every startup. How can one decide which startups to invest in?
Sure, Sujit. I think a great question from many of you. Maybe you want to be like the top 5 investors who make only 10, 15 investments and great returns. We're making it far, far easier for you. I talked about the Ikagai method, where you have the expertise, professional expertise, the interest, or the passion. But if you don't want to do that, you could simply sign up for a 5-star deal program, which is now merging with the Premier Select program, where you tell your RM that to show you only 3-star, 5-star, and 7-star deals, which will be about 10 to 12 deals in a year. These are low risk, unbiased, where at least 2 of the co-founders of IPV are investing, and we have seen generally a better rate of return for these. But you should still allocate smaller amounts, but across 10 to 15 deals for sure.
A question from Prasenjit Bhaumik. How does IPV sense early warning signs of a startup floundering? While investors get an early sense, they are not in a position to course correct. The delay can potentially erode invested amount.
Sure. It's like growing up a child, right? You will get an early sense where the child is going, but you can't give up. If you have an autistic child, you will not give up. Today, you will not. You have the science and the process and the support available to make a great career out of that child. Same way for startups, the Let's Grow program is designed to do that, where investors come together to help. At the back, at IPV, we also have our own categorizations and our own support system and our own turnaround system. We have had multiple examples that Vikram laid out today: Team Monk, Happy Locate, Fab Heads, Sportido, and many others, where we brought the startup either to profitability and sustain or turn around the fortunes, even company like Fab Heads, which is now getting funded by Axel. So all of this is possible. As they say, it takes a village to grow a child, and we need everybody's help on board to be able to support and course correct. It is doable. It's tough, but it's doable.
Right. Another question from Sujit Shah. If we go on taking partial exit in most of the startups, then we may not get the return like 10x or 15x. This high returns in a few startups is required to offset the money lost in failed startups. Your comments, please.
Sure. I think it's a mindset and a strategy you want to go with. I think, and I see it every day over the last 5 years, that if you have a portfolio, 1 failed startup and 9 good startups, your mind gravitates towards that 1 startup, right? If you think that you are tending to be that, which is 90% of the audience, by the way, then it's better to start taking partial startups, and important to have a great sleep at night and still having great returns. But if you have a seasoned investor and you want to stay throughout and have the chance of 15x, 20x, then you should be willing to let go of some failures and see a holistic scorecard, which we also give to our investors who have invested with us for more than 3 years and stayed in more than 20 startups. And there you will generally see an IRR north of 30-35%, even after having a few failures. So you decide what's good for you. For example, if you had the strategy of staying through the end, in Torch you would have made 40x, but in Fable you would have lost. But together, you would have still made 20x, right? But 1 failure, 1 success. That's the mindset you have to identify for yourself. In the end, an investor is the worst enemy of himself. Not the platform, not the deals, not anything else. You got to choose what you got to choose, and you got to be responsible for your own strategy and choices. We can only help, advise, and guide you based on your mental makeup.
A feedback and a question from Saurabh Jain. We should have to expedite the process from the founder call to call for money, as the world is fast paced, so we have to be. Is there any action plan for progress towards this?
So founder call to investor call, we do a due diligence. After investor call, we have to confirm to the founder how much we are committing, and we negotiate the term sheet and the SHA so that we get great rights for you and great protection of money for you. By the way, the valuation is locked and you get the same valuation even after 2 months. Isn't it great? We can still take the feedback and fast forward it, but we don't want to lose out on some things. So it's the best of the both worlds, where after investors call, we take about 3 weeks to send out the CFM. By the way, this is one of the fastest ways across the globe in any angel network, where it takes 3 to 4 months to send the CFM out. We take about 3 to 4 weeks, but we'll still continue to look forward to improve the process. One thing we did recently was to do 2 allocation tranches, where investors who transfer first get 2 months extra for the long-term capital gains to start and save a potential tax. The second tranche goes about a month later for slow movers as well. But feedback taken, will continue to work towards that.
A question from Malini Vishwanath. Those of us who have invested 2.5 lakhs as an initial investment, do we continue with the aforesaid amount or need to increase it to 3.6 lakhs as was mentioned in the presentation?
So for MBA investor, that 1 lakh will continue for some time and for some deals. But from 1st of May, the minimum becomes 3.6 lakhs.
But just to clarify, if an investor call was done before 1st of May, and there you have committed an amount of 2.5, we will honor the 2.5. This 3.6 is for the investor calls from 1st of May.
An adjoining question from Manish M. Increase in contribution size from 2.5 to 3.6 lakhs leads to increase in risk due to reduced diversification. While IPV's fixed cost as also rupee depreciation need to be acknowledged, diversification requires reduction in deal size and not increase. Please give investors some way to having multiple investments at small deal size.
Sure. MBA program is still available, right? You can do 3 deals even at 1 lakh rupees. So that is available. I think the way to look at it is, given dollar depreciation, is if let's say money comes back to you 3x, right? And 2.5 lakhs invested, after 2 years, you're getting 7.5 lakhs back. Does it make you happy? Right? If it does, then maybe 2.5 lakhs is a good amount. But if it doesn't, then you need to reflect. And this number is different for everybody. Right? For me, probably it is 20 lakhs today. If it becomes 5 lakhs, then I'm happy, or 5x. But we think that the base minimum and request from founders, etc., is also becoming higher. And we have just pegged to the same dollar rate over the last 7 years that we have stayed at there. And we hope to stay for the next 3 to 5 years at 3.6 lakhs.
A question from Krishna M, maybe towards you, Mitesh. How is IRR of IPV portfolio calculated? Can you share the formula used?
Great. I already answered it on the chat window, but we'll again say it live for the benefit of others as well. So it's a very, very objective way in which it's calculated. So IRR is basically average of all the startups that we had invested till March 23, because we see that at least 2 years of pedigree or 2 years of hustle that the startup will need to put in before any definite outcome comes. But otherwise, for all the other startup, it is the actual outcome on all your exits. So the 48 exits that you saw, we take the real IRR of that, because this is money in the bank. The 82 follow-on rounds that have happened, we take the value at which the last round had happened and take that as the final number and put it in the calculation. For failed IRR, for failed startups, as we have seen 23 of them failed as well, that will be a 100% write-off, which will be reduced from the overall amount. And finally, there will be still more a few startups where there have neither been any of these events, neither exit nor follow-on or nor failed as well. They are at various stages of still deploying their strategy and eventually will kind of play out the other way, right? There we take it as zero appreciation, zero depreciation. So it's carried at cost. And finally, it's the average of all of this, right? So there is no amount of optimism built over here. There are certain startups which have really grown well in terms of their revenue, their profitability and other things and all. As long as they have not discovered any other valuation outside IPV from any other investor. We will not take any increase in their valuation or will reflect a higher IRR for them. It is purely objective on any definite event that has happened in the startup journey.
The question from Sanjay Jawar, there are investments where invested period is more than 3 years and the investor is in need of funds. Can IPV help on selling his investment to other, or can IPV itself buy on prevailing market price? Maybe towards you, Ankur.
Good. Okay, I'll take it. So I think if you have invested for more than 3 or 5 years and you are in need of money, we have made sure that every such investor in emergency gets their funds. And this happened very acutely during COVID period. Now we are working towards making the system available to larger number of investors. We don't know how much time it will take, maybe 3, 6, 9 months, where you will be able to find some more liquidity options within the investor groups. So yeah, that is going to become a possibility, and we are working hard towards making that a reality as well. In terms of the market price, any purchase or sale of shares or any asset occurs at the negotiated price between a buyer and a seller, right? So the information is widely available. So it then becomes a negotiation between you and the buyer, and that market price could be higher than the last price, lower than the last price, but we leave it to the buyer and the seller to identify.
Question towards you, Mitesh, from Dr. Sunil Bharti. At what stage and how do investors get to know about Idea School? It sounds interesting, but it seems that I have missed the bus every time.
So Dr. Bharti, we are in our third batch. We launched Idea School sometime last year, where idea is to fund and catch hold of startups at very, very early. We catch them when probably there is only founding team. There is a plan, and in some cases, some traction as well. But idea is to catch them early, give them a fixed sum, in this case 1 CR, at a fixed valuation of, in this case, $1 billion. Right? Idea is get in early, work with them, support them. This is an accelerated Let's Grow program where we help them with the next few rounds as well, if they continue to perform well and create good value for our investors. This is available right now, given that the investment amount here, the carve out is smaller. We don't want to dilute these startups, very much at this stage when they are very, very early in terms of valuation and growth also. We'll not dilute them more, and hence we'll keep the investment amount restricted to 1 CR. This is made available to only our premier investors right now, right? So for you to get advantage of this program and invest into these, become a premier investor now, and you'll have firm allocation and Idea School deals as well.
A question from Ravichandran TR. Do we expect another funding winter like a couple of years back? Question in the context of current global turmoil and uncertainty.
Sure. I mean, these are cycles and they occur again. We just tend to forget them very soon. So, I mean, I've been investing for 25 years and I've seen multiple such cycles, whether it was 98, 2001, 2008, 2016, 2020, 2023, 24, etc. Every 10 years, there's a large negative cycle. Every 5 years, there's a small cycle. And every 2 years, there's a small blip. And that's the reality of life. As long as we understand it and we get used to it, we'll be able to take advantage of it rather than the disadvantage. For example, in 21, 22, when the market was at high, we were exiting. We were using that to our advantage. 23, 24, when there was winter, we were using that to our advantage to buy more assets. We believe 25 will be a good year, 25, 26, and we'll be focusing a lot more on exits during this next 12 to 18 months as well. So yeah, it's how you use this and see this environment to create wealth for yourself. Every recession, every low is a great time to buy and great time to catch the bus that you missed last time.
The question from Mahesh Singhal. How challenging is it getting for you to manage the increased volume of investments to review and manage span of control?
Oh, we've been very focused around span of control. In fact, Vikram only did an exercise for us on span of control 3 years back as we thought through how do we scale. Our teams have scaled along, our processes are built. We're getting new investors, new investor mentors to take care of the deals. So yeah, we remain very small in our teams and tags, and each small team is responsible for these deals. I will not be responsible for, let's say, a neural defend or a dream aeronautics, etc. So there are teams responsible for their own deals, etc. So from the outside, we look large, but inside we look very, very small, very, very agile, and very, very focused. Others, please feel free to add as well.
Maybe a question towards you, Ankur. Are you happy with the increase in investor base? IPV is an amazing platform to democratize startup investing, and I thought you would have a much larger base.
Sorry, what was the first part of the question?
Are you happy with the investor growth in the investor base?
Great question, actually. We are happy with where we are. We started, like I mentioned during the, we never started it to build a business. It was basically like-minded investors coming together and helping us through the journey. And that investor base has continued to grow. For us, it's always quality over quantity. But it is also very important that the investor base continues to grow and continues to grow across geographies because of the things that investors bring. Investors bring with them not just their capital, but also their knowledge, their network, their connects. It becomes a source of unique deals. Many of our investors are, alumni of leading educational institutions across the world. We encourage them to go back to their alma maters, bring some unique startups from there. And another thing is that Warren Buffett says, "Be greedy when others are fearful, and fearful when others are greedy." But here is the challenge. The challenge is that many investors do not think like that. So over the last 2 years, when funding, there has been a funding winter, and the number of unicorns has come down, and the headlines about the startups is more about which startup is going down versus which startup is going up. This is actually a great time to invest. But this is the boat when the investors are like, "Oh, I don't know if I want to invest or not." And this is the trend we have seen even in equity markets. This is the trend which we are seeing in private markets. But what is now happening is, like Vinay mentioned during his presentation, equity equity markets is entering into a phase where the growth might be muted over the next few years. Although I am long on India, and therefore I'm long on Indian markets, I know they will continue to grow. But people are recognizing the need for having a alternate asset class. Even like Ankur Warikoo said, have some percentage of your investment surplus allocated to this asset class. And I think this realization is increasing amongst more and more people. And therefore, we expect these growth to continue, the numbers to continue to increase across the world.
Got it. I'm just having a quick time check. Do we continue for another few more minutes?
Yeah, we can continue for 10, 15 minutes. Yeah.
Right. So question from N. Prasad, are there any plans to use AI to evaluate before investments and monitor the companies in portfolio going forward? So yes, Prasad, we are leveraging AI, but at this time, given the stage and the data that is there in the businesses, we do screen them and we evaluate them on a regular basis through our SIP and Let's Grow calls. But we would always be open to kind of using applications and AI to streamline the processes further. Right. I'm just looking at the questions. Just give me a second. Yeah, the question from Neeraj Sharma: if someone is part of AIM, does present process will go where we can invest from 1 lakh to maybe higher as required?
Yeah, so we will honor whatever commitment has been made. So if you've already transferred the money, and you are in, it's not fully allocated yet. So to that extent, yes, we will continue to honor that. And it's as and when that process comes to an end, that's when you will be then moved into the Premier Select program, and then the process will continue. It's just that we have just now combined the services of AIM Plus program and the Premier Select program.
Mitesh, a question towards you. It was great to look at the best IRRs of the investors, but can you share the overall numbers across all investors? What percentage of investors have a positive IRR? What is the average IRR across all investors? Does the IRR differ amongst different programs like MBA, Premier, etc.?
So Amit, we have all sorts of data. We have all sorts of slicing, dicing, right? And that's where the analysis around somebody who's persistent, have done more than 10 investments, with more than 3 years pedigree, will have a very higher IRR as well. So yes, I think this is there. I think in terms of the overall number, we already spoke about it. 41% IRR as per the formula that I just kind of laid out for the overall portfolio basis. How many percentage of investors have positive IRR? That number is also very, very high. But again, we have to call out that there are investors who have just done, let's say, 1 or 2 investment or 3 investment. Now, these doesn't really represent a proper sample size to treat them with positive IRR or negative IRR. We have had investors who have invested in 4 and have got exit in all 4 of them, right? So there'll be always be certain sample sets that we'll have to kind of define with certain minimum ticket size, which in our case we put it as 10. Now, anybody who has put in 10 investments at least, right, across any number of years and all, here, the percentage of investors with positive IRR is about 96%, 97%. Right? So I think this is something which we have extensive amount of data, and that's what we keep sharing on all of our sessions like this as well as masterclasses.
Question from Krishna. IPV doesn't showcase most startups that do well again to larger investor base. Typically, it is the struggling ones. Any reason why?
I'm not sure what. Sorry, go ahead, Will.
No, go ahead, Nitesh.
So not sure what's the context over here, whoever has asked the question, but it's in fact exactly the opposite, right? We will show startups for round 2 wherever they are doing well, because for us, round 2 is as good as akin to a new investment. The new investor also who joined after the round 1, they will also participate. So there'll be a proper diligence around round 2s as well, where it will be presented to all the investor base, right? And we will highlight. Today morning I did Cooper, for example, and it was around 3. But such is the quality of the product and founder that we are convinced that it can go for one more round, and definitely our investors should take advantage of it. There will be some cases where we will very clearly lay it out that the startup needs support, but that is also subject to them having potential. We'll never present startup which might be struggling today, but which are low on quality or where we do not have belief in their execution skill or the founding capability. So it will always be good quality startup and not the struggling startups.
Question from Ram Mohan K. In few SIP calls which I recently attended, participation is very less than 10%. Any plans of improving?
So, we started publishing the decks ahead of the SIP call on the app. And we also started publishing the recordings of the SIP call on the app after the call. And as you would imagine, because the recordings are available, decks are available, people don't want to join in. So it's a fine line balance between the 2 requests. Some people saying we need the decks and the recordings, which will definitely lead to a lower number of attendance at SIP calls. But many of these investors hear the recording on the app, and we have to respect, not everybody may have all the time to attend all their SIP calls. So we are trying our best to make it available in the form that you can. And those who find the value in joining, join in. And those who want to see it at their own free time, they can do as well. So that's probably the best of both the worlds. But yeah, those who join in get to see the live questions, get to ask the live questions, which those who don't join in live don't get to ask.
An adjoining question from Manish. Have noticed quality of SIP calls slipping over the years. Needs to be anchored by experienced IPV rep. Often SIP decks are uploaded late.
Yeah, that's the perception, right? And that's why we measure it very sharply. And that's why Vikram showed you the data. We made sure that the data is published today. 88% of the decks were uploaded in time before the call, right? And by the way, we do 700 such calls in a year, which means only about 70 out of 700 times or 80 times we were not able to upload it on time. And the 2 questions are kind of conflicting, right? Saying, why are there not too many attendees on SIP calls versus why is it not getting uploaded on time? But we are trying our best, right? We work with 250 founders to get these decks to you 4 times a year. And sometimes things happen, right? So that's the reality of life.
A question from Manish M, or more a suggestion. Please keep 20-30 minutes gap between the 10 a.m. session and the second session. It gets exhausting.
We understand. So we have a 30 minutes gap between the second and the third session, which is 11 to 12 is the first founder call. And then 12:30 to 1:30 is the next founder call, right? And these founder calls are available as recorded as well. We have to be mindful of multiple time zones we support. multiple types of investors we support, and we also don't want you to be glued to the screen the whole day. So we want to be efficient about it. And that's why our calls start dot on time and finish dot on time, so that you can plan your things around it.
And just screening through for the most important ones. Question from Rajesh Nair. How are we calculating percentage failure? Isn't it too early to conclude? Because that is a very premature conclusion, as many companies are still in process, and it could misguide people as they think that 90% is success rate. Please clarify on this.
So let's put it that way. Mitesh showed you the number of deals that have given full exits, partial exits, follow-ons. Add them up, and you will see what percentage is success. You may say that 10% on the overall base is skewed a little bit. Maybe you want to do the number of startups that have failed and exclude the last 1 year's number, and maybe that 10% will go to 15. Maybe it'll go to 18, right? But the kind of returns we are getting across these, up to a 30-35% failure rate also will have great returns for our investors, far ahead of the market by far, right? So, but we have been very consistent in reporting our numbers, and we want to stick to that consistency over time. And this year onwards, as we have more exits coming in and kind of a balance coming in, this number will also stabilize in the next 1 to 2 years itself.
Also, just to add, calling a startup failure or failed startup before it has actually failed and shut down the shop and all will be harming the startup even more, right? A lot of cases we have seen, you support them, they are maybe today feeling low, but there is always a movement of turnaround. And we would like to kind of go till that last moment to support the startup to see if it can be turned around. So let's not hurry into kind of calling a startup failure, because the moment we categorize as a failure, the word goes around in the market. Even if whatever hopes of revival are there for the startup, that will completely diminish.
Question from Nasir Burdestani. Is there a plan for IPV to raise capital from its investors?
Answer, we never say never, but answer currently is no. We never imagined it. We don't imagine it today. The whole business was built on very strong fundamentals, very strong, care, a very disciplined way of working, and a very strong, skin in the game. We don't want to have external investors and take our shares out. That's not the case, and that has never been the case. Second, another reason is we run against the grain. We are greedy when the market is fearful, and we are fearful when the market is greedy. And if we get external investors, that strength will go away. We will get determined our choices by the quality of investors we get on the cap table, right? And we don't want to lose that independence here. By the way, we are the only platform in the country that is not funded with external capital. You take VCATs, you take Let's Venture, you take WFC, and many others. They are all funded external capital, and you see the quality that degrades over time. We don't want to degrade that quality for you, and we want to retain that skin in the game, that disciplined operation, that great exits for all of you, and common success for all of us together.
There are a lot of questions around getting the recording offline. I think, and to share it with their loved ones. So we will make it available for some time on the app. So please do go to the app, and you will be able to access it for some time and go through the questions as well as the session again.
Yeah, for 15 days, we'll make it available.
I'm just going to go through a few other questions. One question from Saurabh Jain. Can we see the more detailed status of the current active startups? At times, some are looking for bridge round support from IPV. It would be nice if we can see an easy way to get the status of any such requests.
So go to your deal section now. It has been revamped. We got a lot of feedback over last year, and all of that is now included in the deal section. A lot more will come during this year, and you will definitely enjoy the new revamped section with all this information and stages.
A question from Rakesh Rathod, or a suggestion from Rakesh Rathod. Please share all initiatives on WhatsApp as well, as we miss them in email.
WhatsApp is becoming difficult as more and more social media controls are coming in by the government, and Facebook is becoming far more selective. Not all our messages are reaching the investors, and therefore we are being very sharp about what goes on WhatsApp and what not. And the chances of it getting marked as spam by many of you, which means it will not reach anybody. So we are working through that, but we are trying to make sure that you get enough information from us on an annual event rendezvous, on our founder calls, on our master classes, on email, on WhatsApp, on Zoom, on chat, and on app. So multiple ways of communication that we're keeping live over and above the RM that you've got. Talk to them and you will hear a lot more and you get anything you want.
A question from Alokik Tiwari. How much percentage of portfolio should be invested in startups?
As you saw Ankur present or I presented, 8% is what Indian HNI allocates to it to this with a significantly higher wealth creation. It's a mindset, not how hard you work or how much you earn. Your wealth will be determined by your mindset and your allocation, portfolio allocation and support.
Rajesh Nair asks another question. For startups that went bust, how can we get loss statements for tax relief?
So we do that. We have a process where every startup that fails, we enable the buyback of those shares at 1 rupee so that you can formally file your tax returns and get the tax credit back. So even if you invested 100 rupees, you still get 33 or 40 rupees back, even in that startup.
Question from Siddharth Gupta or another suggestion. IPV should explicitly state its recommendation for any preemptive round.
It is there in the FAQ, how we think about preemptive and how they are positioned. We do the scorecard still. Preemptive, if we are not doing the round to ourselves, that means that we find the valuation to be a little bit higher or not worthy of bringing it as a proper round two. This is very well documented in our FAQs. Please refer to them and you will get full philosophy around preemptives and how you should think about this.
Another suggestion from Vinod C. It would be good if reasons for dropping deals are published.
We don't publish them, but we can tell you if you want to ask, because then it becomes public for the whole world to see for that specific startups. And those startups may not get funding from anywhere. And by the way, we could be wrong too in passing a startup. Doesn't mean that my mistake of passing a startup kills the startup forever. You don't want to publish a failure child's scorecard in public in school.
Great. A question from Shailaja. How do you compare IRR and sustainability wise a technology-based manufacturing startup versus the SaaS-based startup?
Mitesh, if you want to take that too.
I'll repeat the question, Mitesh. How do you compare IRR and sustainability for a technology-based manufacturing startup versus a SaaS-based startup?
Very subjective, to be honest. I think each one will have its different characteristic. Even within the same sector, startup to startup will differ, right? So for both these sectors, again, the answer will be different. A SaaS startup, let's say, which is into enterprise SaaS, right? The sales cycle might be longer. So while the product might be powerful, but how do they monetize, right? And the capability to kind of ability to sell, that will be longer. And then on top of that, the retention might be better as compared to any other B2C brand. So I think sector-wise, this will differ. Our IRR is basically at a portfolio level. You'll have many of these in your portfolio from different sector, and ultimately, it's the sum total of all of these at a portfolio level that will define your IRR, right? But like Ankur just said, 30% IRR is ridiculous. So at an overall portfolio level, if you are looking at an IRR of 41% today, and maybe 30%, even if a mellowed down approach, I think that's a great return.
And if we are trying to do a risk reward analysis, then I think this is very well captured in the scorecard, where we also, among other things, discuss about the downside risk, where we also talk about what could be the possible downsides to that startup. SaaS business may not always be dependable, cash flow generating, especially if, like when Mitesh mentioned, sales cycle is long or if the product is in the early stage of development. At the same time, manufacturing tech startup could also be, depending on the stage it is, could be far stable cash flow and far steady. So those are the things which we do capture on a case-by-case basis in the scorecard.
A question from Ramohan K. What are IPV's plans for 25-26?
We can have plans, but market will determine whether those were right or not. But the 4 or 5 big things is a significant upgrade to your experience on the computer, a significant deep dive into MENA and SEA regions and opening Canada and America region, a differentiated investing with IPV Ultra, where you can invest with VC funds and the big deals. This we don't expect to be a large pool of investors, but maybe about 100, 200 investors that will be limited to that set. A great app experience for you, which should be globally the best. A great investing through FISIS Capital, where we will start supporting growth stage startups. And of course, our hopes for some great exits and great IRRs for many of them.
Question from Malini. How do angel investors like me get to know the exit options? I think I have missed noting them. How do I keep myself updated on this?
We update this in the WhatsApp groups, but go ahead, Nitesh.
Multiple ways. I think one, whenever there is an exit opportunity, or even if a preemptive round is happening, a follow-on round is happening, you'll get complete details on the WhatsApp group, right? If you are not somebody who's very, very savvy with WhatsApp, a mail will also be sent out to you, and you can check it out on the mail as well. Right? And more often than not, we also try and see if these alignments are also, if these sort of announcements are also covered in the SIP round if it's happening sometime around soon, right? So even if you look at the SIP call recording and all, details about the round and the exit opportunity also sometime will get discussed on the SIP call as well. But I think WhatsApp is the best medium because whenever the exit announcement is made, with that an exit form also goes out. So if you are looking to take that exit interest and want to kind of opt for that exit, you need to fill up that form and give your commitment within next 3 to 4 days for a foreseeable time, because then the team will start processing it. So keep an eye on that WhatsApp group or your mail, whichever works better for you, and respond within time.
A question from Sujit Shah. Earlier you had leadership board. Can you have the leaderboard of number of startups invested or highest IRR made leaderboard?
No, we don't want to publish personal details of people because that is data that can be publicly misused. And if I was to publish your 100 deals that you've invested in, or that you have invested 100 deals, you may not like it, and you may not want us to publish that.
Even the names that we have shared here, there are some more names that could have come here, but some of our investors didn't want us to even recognize them on a public forum like Rendezvous. So we took permissions of our investors, before calling out their names here. Also, we are very respectful towards that.
I think a question from Vikas. Do you charge exit load fees on exit?
We charge documentation charge on exit, which is 2% of the exit amount for all the hard work and documentation that goes around. That's where most of our bulk is. But we have for select 500, 600 investors who don't want to be active investors with us, but want to rely on a lot of advice and support, or want more time or dedicated RMs or committed deals. They have, instead of a documentation charge 2% on exit, they pay 16% as a carry or a profit share. So you choose your plan.
I think we more or less covered all the questions. I think there's a question from Dilip Kumar. Does Premier plus NRI member again take a international membership? Ankur, maybe towards you.
Yeah. So if you sign up currently before April 15th for the Gift City, we are giving you the Gift City membership for a year. But after that, once you take a Gift City membership, it will include the membership for the Indian AIF. So you do not have to pay separate fees for Indian AIF and the Gift City membership. But yes, if you're transitioning from Indian to Gift City, then you'll have to, as and when your membership expires with the Indian AIF, you then have to pay and take the Gift City membership. So what we are making sure is that at no given point of time, you have to take 2 memberships.
Great. I think we've answered over 110 questions.
And that is a very good question to end, because Gift City is something which we're very excited about. It does bring a lot of benefits. So thank you, investors, for asking us that question. Let me take this opportunity to thank all the investors who took time the valuable time on Saturday evening. Also, a big round of applause and thank you for the team behind Rendezvous, led by Vikram and Aditya, Rishi, and Sahil, and many other people who have worked behind the scenes to get us where we are. Thank you, everyone. This is something which we love doing. We love bringing this. Bushra is one name I was missing also as well. So I'm recognizing the team which was very, very actively involved. We love doing this, Rendezvous. Like Ankur said, more people should be doing it, but we don't care about that. We care that we should do it every year. Bring in what we believe in, bring in how the year gone. We are not shy of making statements. Sometimes we do tell Vinay, don't make this statement like that, but Vinay often disregards it. He accepts it in person and then disregards it on the public platform. But that's it. That's what you get from us. You get transparency from us. We want you to continue to keep trying out our platform, giving us your feedback. You will see every year we take that feedback seriously. We keep working on it. We do want to become the most trusted angel investing platform in the world. That is our goal. That is our motto. So towards that, we will continue. So thanks, everyone. Have a wonderful evening and a great weekend ahead.
Thank you,
Thanks,
everyone.
everyone.
For your time.
Thank you so much, Vinay, Ankur, Mitesh, Vikram, and the team. It was absolutely, I think together you have answered more than 100 questions without a glass of water. I didn't see many of you drinking that, so that's really commendable. Thank you very much. And to all the people who logged in, thank you for spending enriching evening. I hope it was enriching. On the screen, you have the QR code. If you haven't already downloaded, there were links also shared in the chat. Feel free, if you're not a member already, feel free to avail the discount available for today as a special gesture. Also, if you would want to join as trial members, there's another QR code and links have been shared. Thank you once again, everybody, for joining the Rendezvous.
Thank you.
Thanks, Ruchi. Thank you, team, for being there. Have a great weekend ahead.
Thanks, everyone.
Bye-bye.
Thanks to you as well, Vikram. Highly appreciate. And Ruchi.
We will have the screen on for another couple of minutes in case you want to avail the offers available. Team, you can stop the recording.